Well, now to look at the impact of mortgage foreclosures on U.S. banks. I'm delighted to say that I'm joined by Tim Ryan. He is president of the Securities Industry and Financial Markets Association, and that's Wall Street's biggest lobby group. Thank you very much for joining us on The Pulse today.
Good morning.
If I could begin by talking about the foreclosure situation in the U.S. We heard in that report that it seems to be continuing at pace. What effect is it having, and is it likely to increase?
Well, let's divide this up. First of all, the foreclosure issue is more about documentation specifically, and our view and our members' view, which are basically all of the major originators of mortgages, the servicers of mortgages, and also the same companies who actually package and distribute mortgages in securitization. Their view is if there are legal issues, if there are process issues, we want to fix them. And we're doing that right now, which is why some of the larger originators basically stopped the process of foreclosure in order to make sure all the documentation was correct. That's now being rectified. So
there have been these calls for foreclosures, a sort of a 2-week moratorium on all foreclosures. What's your take on that, and what effect would that have?
Well, it would be catastrophic to have a across-the-board moratorium, and the people who would really suffer are the people who have invested in mortgages through the securitization process, which are really the general public in the United States and actually globally. So we're very much against the moratorium. We are very much in favor, and the large originators are now doing this. Fix the paperwork, fix the process, and then move forward with foreclosure.
Now, the banks do face problems because of the rate of foreclosures in the U.S. And do you think that that is likely to go on for some time and have quite a large effect on banks? I'm thinking of banks like Bank of America.
You know, the financial crisis and the results, some of which is seen in the mortgage market, is something that we're trying to work our way through. The sooner we get through that process, which is really why this foreclosure is the final stage, the better off we are. So we've been systematically moving through this, and my hope is that the foreclosures will go down and that the economy will pick up.
Banks have got an awful lot going on with them at the moment. We've had Basel III, which obviously everybody across the world is digesting. In terms of U.S. banks, it is going to mean quite an increase in the Tier 1 capital requirements that they have to have, isn't it?
Yeah, but you need to take Basel III really as an incorporation of some of the decisions that have been made by the G20. The U.S. has taken much of the G20's requests, some of which come out of Basel, and incorporated into a new statute, which we call Dodd-Frank, which is now in the implementation phase. That will produce higher capital standards for the financial institutions globally. And our members really do business all over the world. We're very much in favor of smart reform that strengthens the banking system and produces a diminished risk, basically, for governments.
And do you see this as smart reform, or do you have concerns over it?
It's almost too early to say, because we're in the implementation phase, whether it's in Dodd-Frank, where we have about 300 regulations that are now being drafted, or Basel III, which is very much kind of in development now.
Are you concerned that this will create a playing field that is not level globally, and that it could therefore have banks based in banking centres like New York and indeed in London looking elsewhere to base themselves overseas?
It's a risk. If we overshoot the mark from a regulatory standpoint, or quite frankly from a tax standpoint, it will have an effect potentially on some of these major financial markets, because global business, especially in the financial markets, as you know well at Bloomberg, can move around. They all do move around on a 24-hour basis. It's not a fixed asset.
Okay, that's very kind of you. Thank you very much for joining us
and
sharing your insights this morning.